In Chapter 4, we'll be doing some review, and then we'll be also going over the reconciliation worksheet for budgetary accounting. So if you look at the Chapter 4 lecture notes, we'll go over a couple things first. In this chapter, we're going to be talking about making closing entries. So in the prior chapter, we talked about budgetary accounting, and we talked about some journal entries. And in this chapter, we're going to be talking about the closing entries. Now, for closing entries, there's two ways to do it. You can either close all of your journal entries in one step or in more than one step. So the one-step approach is a lot easier to learn, so we'll go over the one-step approach a little bit later in this lecture video. Now, keep in mind that the textbook uses the two-step approach or multiple-step approach. Basically, the multiple-step approach is like in financial accounting when we use income summary and then we close income summary to retained earnings. So it's extra steps, and it's more complicated, I think, when you do extra steps, but we'll do everything in one step together. Let's review a little bit. So fund balance. Okay, so we know fund balance comes in 5 different types. So remember, for governmental funds, they have a fund balance, and fund balance can be either non-spendable. So non-spendable is something that you simply use up, or fund balance, let's look at the bottom here. Fund balance can be unassigned. That means you can use the money for whatever purpose you want. We call that unassigned. If you think you're going to use the money for a certain purpose, we call that assigned. For example, if you're going to go out and purchase something, that would be considered to be assigned. Committed is internal. So know that committed is when somebody on the inside says that money is going to be spent for a certain purpose. So for example, a school might have a board of directors or a board of regents or a board of trustees, and they commit to spending money for a certain purpose. Right? Here the example is a fund formally committed to purchase a commercial time on television. This is somebody on the inside, like the chief marketing officer, for example. Restricted means somebody external, somebody on the outside is telling you that you have to spend money for a certain purpose. So if you accept state grant money, maybe that money must be used for public works. So somebody on the outside is telling you how you have to spend a certain amount of money. Okay, so we remember that governmental funds come in 5 types. So the last one is not here, but you can see the last one would be permanent fund. Right, so we're going to add that here, permanent fund. Okay, so there's some confusion about the difference between special revenue and capital projects. Okay, so let me talk about that first. Capital projects are where you accumulate money that's going to be used for a capital project. For example, if you're going to be building a bridge, or if you're going to be building a new building, or if you're going to be laying down a new road, that would be accounted for in the capital projects fund. So capital projects are for some type of capital project. Special revenue funds are like capital projects, but typically they are not capital project related. So for example, let's say we have a gasoline tax for special revenue fund. If we have a gasoline tax and the tax is going to be used for educating consumers, okay, on the dangers of cigarette smoking, that would be special revenue fund, because you have a specific stream of revenue that's going to be used for a specific purpose. Typically, it's not capital related. Okay, the thing to know is that when you have a special revenue fund, revenues or money that you get are typically going to be restricted or committed. That makes sense because a special revenue fund acquires money that's going to be used for a specific purpose. So of course, special revenue funds are going to have restricted and committed fund balance. It's not going to have unassigned because unassigned means you can do whatever you want with the money. Special revenue is not money that you can do whatever you want with. It has to be used for a specific special purpose. Similarly, debt service funds mean that you acquire money that's going to be used to pay off principal or interest. And here, debt service funds have three categories: restricted, committed, and assigned. If you have a debt service fund, the money must be used to pay off principal on a loan or pay off interest. Again, here for debt service, there is no unassigned category because unassigned means you can do whatever you want with the money. Capital projects funds, that's where you accumulate money that's going to be used to build a new factory or a new bridge. So of course, these funds are going to be restricted, committed, or assigned. Again, there's no unassigned category. Okay, a couple of other notes here. Modified accrual basis of accounting. So we talked a little bit about modified accrual. And just to review here, modified accrual is only used for governmental funds. Also, for modified accrual, it means that instead of expenses, we have expenditures. We have an emphasis on current assets and liabilities. That means that we have no long-term assets, no long-term liabilities. And finally, modified accrual means that we have additional special rules. Okay, so it's a little bit different. So let's talk about some of these special rules. If we use modified accrual basis of accounting, this is for governmental funds, what are some special rules that we have to follow? Well, one rule is that when you have property tax revenue is revenue under modified accrual basis of accounting if you can collect the money within 60 days of the end of the year. Okay, so that means if we use modified accrual basis of accounting, when do you have revenue? Well, we have property tax revenue as long as you can collect the property tax money during this year or 60 days after the end of this year. Then all of that is going to be property tax for the current year. Also, expenditures. Okay, so we have two methods for dealing with expenditures if we use modified accrual basis of accounting. One is called the purchase method. That means as soon as you buy inventory, it becomes an expenditure right away, as soon as you pay for it. The other method is that you have expenditure when you actually use the inventory. Okay, so just know for modified accrual basis of accounting, there's two ways to handle inventory. Inventory can either be an expenditure as soon as you buy it, that's called purchase method, or it can become an expenditure only when you use it. Now, my question for you is, if you use GAAP, generally accepted accounting principles, in financial accounting, regular financial accounting, what method is used for inventory? Is it purchase or consumption? The answer is consumption, right? So this is used for GAAP. Okay. So a couple of other things. Tax anticipation note means the government borrows money based on their expectation of tax revenue as collateral. So the interesting thing about governments is that they can tax you. For example, they can charge you property taxes, and they know they're going to get their money because if you don't pay, they'll just repossess your house, they'll take it over and then auction it off. Right? So governments have a very steady stream of revenue, and based on, for example, property tax revenue, they can borrow on that future stream of income. We call that a tax anticipation note. Basically, it's a loan collateralized by tax revenue. Next, you should know that governmental funds can do business with one another. Okay, so if one fund loans money to another fund, we call that an interfund or interfund loan or interloan fund. Those all mean the same thing. If you have one department that provides services to another department, for example, the printing department is going to provide brochures to the accounting department, then that's called an interfund service. If one department simply gives money to another department, it's not a loan, it's just basically a gift, we call that an interfund transfer. Finally, if you have one fund that pays for an expense that another fund has, we call that an interfund reimbursement. So for example, in real life, if you go out to lunch with somebody and somebody else pays for your meal, then that's called an interfund reimbursement. Okay, so let's take a look at an illustrative problem. We're going to do some journal entries here. We're going to make the closing entry. So remember, closing entries, you can use multiple step or single step. We'll do the single step process for closing entries. And the thing to remember is when you do a closing entry, remember, close out all of your temporary accounts. That means you close out all of your revenue, expenditure, and budgetary accounts. In financial accounting, usually you plug to income summary or retained earnings. In governmental accounting, we're going to plug to fund balance. Plug just means use that account to make the journal entry work. Use the account to make everything fit together. Okay, so let's take a look at this problem here. So we're going to do the journal entries first, then we're going to make the closing entries, and then we're going to put everything into a worksheet. Let's take a look at this particular example here. Here it says to prepare the general ledger journal entries for the general fund for the Village of Red for the year ended December 31st, 2014. So you can see here that we're going to be using budgetary accounting. So budgetary accounting is going to create more work, and in this first example it says a budget is formally adopted and they estimate revenues at $3,000 and appropriations are estimated at $2,500. Okay, so a couple things here. Estimated revenue is the amount of money you think you're going to get. Appropriation is the amount of money you're allowed to spend. So nothing has actually happened here. This is just budgeting or planning for the future. So in the journal entry that you would make, you think you're going to get $3,000 in estimated revenue. So you debit estimated revenue for $3,000. And we're going to make one journal entry here. Appropriations, I think I'm going to spend $2,500. So you credit appropriations, $2,500. Take a look at the Chapter 3 notes if you need a review for the different budgetary accounts. Once we put in revenue and appropriation, then the plug is going to be budgetary fund balance. Why do we say budgetary? Because this is a budgetary account journal entry. Okay, next, it says revenues were received in the amount of $2,900. So if you receive revenue, you get cash, so you debit cash, and you credit revenue. So revenue control or revenue is fine. Credit revenue, $2,900. Next, let's talk about purchase orders. Okay, so a purchase order is when you decide to buy something. So in budgetary accounting, if you decide to buy something, you have to set the money aside. You have to reserve the money. When we reserve money, we're going to make a special journal entry where we debit encumbrance and credit budgetary fund balance reserved for encumbrance, $1,600. Now the good news is anytime you see purchase order, you always make this journal entry. Next, it says that purchase orders representing $1,000 were received. The actual amount that we have to pay is $1,100. Okay, and then we're going to make the journal entry for this. Okay, so in Part C, we order $1,600 worth of stuff. In Part D, part of our order shows up. So I want to show you here. We order $1,600 worth of stuff, and $1,000 has been received. So 1,000 out of 1,600 is 62.5%. Okay, so we get 62.5% of our order. So we're going to make this journal entry here. This journal entry reverses the journal entry here. So it's releasing some money. And we have an expense and we have a payable for 1,100. 1,100 is the invoice amount. It's the amount we actually have to pay. Next, it says that we have salaries, which we owe. So there's no purchase order here. We just have expenditure and cash, $1,200. Next, it says other financing sources of $100 are received. Okay, so other financing source is a budgetary transaction. You get cash, $100, and then you credit. You can use either transfer in or you can say other financing source, $100. Either one is fine. Okay, that's it for the journal entries. And look at this closing entry here. This looks pretty overwhelming, but I want to point out a couple things here. This is the one-step approach. So everything is in one journal entry. This is one big journal entry. When you make closing entries, take a look at this, and then we'll go over the steps for making the closing entries. Okay, so for closing entries, if you look at the instructions here, we want to close out revenues, expenses, and budgetary accounts. And then we use fund balance last. Okay, so how do we do that? Okay, so here's what we do. Okay, so we're going to go one by one. And budgetary accounts, okay, so we have this. We want to close this out. Estimated revenue is debit for $3,000. So what we do for the closing entry is estimated revenue. You do the opposite. You see, we credit for $3,000. Going back here to Part A, we have appropriation. We credit for $2,500. So how do we close appropriation? We're going to debit appropriation for $2,500. Budgetary fund balance, $500 credit. How do we close that out? It's a budgetary account. It has the word budget in it. We're going to debit budgetary fund balance, $500. Okay, so you're going to do that for all of your budgetary accounts, all of your revenue accounts, all of your expenditure accounts. And then to make this journal entry balance, we have to put fund balance 700 on the credit side. That's called a plug. It means you put it there to make everything fit together. This is a closing entry in one step. Okay, so if the fund balance was $5,000 at the beginning, what would the fund balance be at the end? Well, look at the closing entry here. We credit fund balance for 700. Fund balance is kind of like stockholders' equity. It increases on the credit side. So what's 5,000 plus 700? It's 5,700. Okay, finally, we can put everything in a chart. Okay, so this chart just shows everything in one place. Now, this chart is not in the book, but it's not difficult to figure out because there's only three things that go in the chart: encumbrance, expenditure, and appropriation. So only three things go in the chart. If you have revenue, where does it go in the chart? It doesn't. Okay, so what we do is we just look at these three accounts: encumbrance, expenditure, and appropriation, and we're going to put the numbers in here. And let me show you how this works. Okay, so let's take a look at journal entry A here. So take a look at journal entry A. We credit appropriation for 2,500. See here, we credit appropriation for 2,500. So in our reconciliation, we're going to say appropriation. We're going to call that A. You can call it number 1 if you want. We have an appropriation. We credit appropriation for 2,500. So how much are you allowed to spend? How much is available? 2,500, because we credited appropriation for 2,500. The next time you see the account encumbrance, expenditure, or appropriation is in part C. Let's take a look at part C, going back up here. In part C, it says you have a purchase order for 1,600. So we have debit encumbrance, 1,600. Okay. So debit encumbrance, 1,600. So going down here in the chart, we can say part C, encumbrance. See, debit, encumbrance, 1,600. So how much did we encumber? How much is open? How much is set aside? 1,600. So if you set $1,600 aside, how much is still available to spend? Well, I used to have $2,500 available to spend. Now I put $1,600 aside, so 2,500 minus 1,600 equals 900. In part D, we have two things going on. Let's take a look at part D. Okay, so part D was D up here. Okay, so we release some money. So we have encumbrance, credit for 1,000. So we release $1,000. And we have expenditure for $1,100. So those are the two things that happened. You release release encumbrance, you have expenditure. We can put that in a chart. We release the encumbrance. So if you look at the problem again, we credit encumbrance, you credit for 1,000. So if you release $1,000, how much is still locked up? How much is still set aside? Only 600, because it's 1,600 minus 1,000 is 600. If you put $1,000 back in the big pot, if you put it back in the main area, how much is available now? You can see we have 1,900. That's $900 was available before. You release 1,000, so 900 plus 1,000 is 1,900. Also, in part D, we have expenditure. So expenditure, we can say expenditure, we debit expenditure for 1,100. So how much expenditure do we have? 1,100. And once you actually spend the money is gone. So how much money is now available to spend? Well, we had $1,900 available to spend minus 1,100. There's only 800 left. 1,900 minus 1,100 is 800. Now, in the last part, part E, it says we have a salary expenditure. So if you look at the journal entry, we debited expenditure for $1,200. So what is the total expenditure we have? Well, we had $1,100 from before, plus $1,200 is $2,300. How much money is available to spend? Well, we had $800 available to spend, minus $1,200 more, right? That's how much we actually spent. 800 minus 1,200 is minus 400. So we overspent our appropriation, right? Which is not a good thing. Okay, so then the last number, in this open column, the last number is 600. So you put 600 here. The last number is 2,300. That goes here. The last number here is 2,500. And the last number here is minus 400. Okay, finally, I have a couple of random questions for you. The one thing I'm going to point out, I put the answers here so you can do these yourself. The one thing I'm going to point out is that there's only one general fund. Okay, so general fund is only one general fund. There's only one default general fund. Everything else, there can be more than one or there can be zero, right? So special revenue fund, if I don't have any special revenue things going on, it could be zero, or I could have like 5 special revenue funds. If I'm building 5 bridges, I could have 5 capital projects funds. Okay, so take a look at these yourself, and if you have any questions on the Chapter 4 notes, please let me know.